Okay, welcome back to the lobby. I guess we call it the lobby, right? I hope you had some good discussions in the breakout rooms. And we want to start taking some questions. Obviously, we've seen some posting there. Welcome back. Welcome back. So we've got some questions being posted there. Feel free to keep posting questions in the lobby here. Jim and I will be answering them. But we're going to start with a couple that were posted in the discussion group online first, and we'll kind of intersperse those with the questions you're asking here as well. So I think I'm going to take them in order here. I'll take the first one that was posted in that discussion group. There's a question about opportunity cost, and I was taught that opportunity cost shall not be included in income statements, and that is true. The opportunity cost is something that you would not, in your historical statements, account for, and you wouldn't report it because it's something that didn't happen. But remember, with the cash flow analysis, we're looking forward, we're projecting what will happen, right? And so we want to incorporate the costs so that we're going to forego, and it comes back to that with or without concept we talked about in the cash flows and determining whether they're relevant or not, is the whether that's relevant or not, with or without, opportunity costs do come into play. And so the difference is, because we're projecting cash flows to make a decision, you can incorporate opportunity costs, but in your accounting of historical performance, you wouldn't be doing that. So I hope you can distinguish that. And I think it's an important point. A lot of accounting is trying to describe what happened in the past and be accurate. And a lot of the cash flows and the projections and the financial analysis is trying to guess where it's going to go, where our initiatives are going to go. And so those are projections. And so that time reference is an important thing to consider. You want to take the next question, please?
Sure. Next question states, what are the supply chain elements included or derived from balance sheet and income statement that contribute to financial performance? Are there specific accounting ratios? Let me take the first one. The supply chain contributes to, simply put, if you look at the income statement, you have a revenue line, which is a top line. You have costs. You have material costs, which are basically COGS, or cost of goods sold. And then you have some of the operating costs. The supply chain contributes to each of those areas, either directly or indirectly. If you look at the revenue line, you could say, well, the supply chain, by virtue of enabling a company to get a product out to market faster, or getting a product out that's of higher quality, or that has specific functions and features that are desired more capably than their competitors, that's going to enable the company to enjoy more revenue, either from higher price points or from more share. Right? So the supply chain can enable adding to your top line. The supply chain, of course, has very direct impact on the cost of goods sold, which is, of course, what the supply chain is managing. They're managing the cost of the acquisition of raw materials that are used in the creation of products. So that's a very direct line. In the operating expenses, there are some other indirect expenses that the supply chain has some impact on. And so we can see that the supply chain has impact really throughout the income statement. If you look at the balance sheet and on the asset side, you'll see that one of the most significant control items for the supply chain is inventory. That's directly controlled by supply chain folks. Now, the determination as to how much inventory is carried is really more a function of how the company makes decisions and who decides that. But certainly the supply chain group is the one that's managing that. The supply chain personnel often have some impact on accounts receivable, which is another balance sheet item, and then also on accounts payable, which is a liability. And so those are some of the supply chain elements that you can find directly impacting the income statement and the balance sheet. And let me see, the second part of that question was, are there specific accounting ratios that are affected by supply chain performance? Or the most? Well, based on what I just said, you could find really the supply chain having impact on many of the supply chain, many of the financial, on the ratios. So even the return on investments, we could find an impact. It's difficult to find it very an isolated direct impact from one particular supply chain action for large companies. But that being said, they can have impact on that. One of the more direct ratios that you can find, direct impacts you can find in a ratio is a return on net assets, because you're looking at the impact that inventory is going to have. Often you will find in our course that we teach, there's a case we use where there's one ratio called GMROI, that's gross margin return on investment, of investment inventory rather, sorry, inventory, specifically used in the retail trade, which again is focused on that inventory figure. So those are just a couple. Jared, do you have any?
Well, I just want to say generally, our weeks didn't cover this, but our course does. We didn't cover everything in the online course that we do in our residential course. But financial analysis, or often called ratio analysis, this is what financial analysts do all the time to determine whether they want to invest in a company or not. And there's a lot of ratios, and in fact, sometimes it's not a science. It's not like physics or engineering where we have clear definitions of ratios. But there's various ratios that they will use to make a decision. And I think that supply chain influences a lot of them, whether it's immediately and directly. It's hard to say, but it's hard for sales and marketing to say that they affect the ratios directly either. But understanding where supply chain plugs into those ratios, I think, is critical. And these will often end up being kind of some of your bonus. If you're in a company, your bonus might be tied to some kind of financial metrics. Understanding how your role fits into that is an important thing. So we didn't cover it here, but we will. That's something we cover on our course. That's important to consider how supply chain fits into that ratio analysis. We have another question kind of related to accounting and kind of software, and how do we actually account for things. Maybe Jim, you can talk about that, kind of accounting and software.
Oh, well, so in terms of the accounting software, Jared was suggesting that QuickBooks is a common tool that many organizations use. Now, I want to be careful to say we don't advocate for one particular vendor's product versus another's. But we can say that QuickBooks is often used. You'll also find that within the enterprise research planning tools or systems that your companies use, there'll be a particular module that will have financial management tools. Some of those are effective. Some of those are not necessarily as effective as bolt-ons. And but I think within those between QuickBooks and what you find in the ERP, those are some software systems.
I would say ERP systems are often implemented by companies because they want to manage their finances, right? That's where it starts.
That's right.
And they've expanded, but it used to be kind of financial management that became enterprise resource planning because it incorporated the operations, and it demonstrates the importance of operations linking into the finances. So I think that's what. But a lot of big companies will have those. Smaller companies may not. But there's a lot of different software out there. I would also say, interesting. I do a lot of research. My research focuses on developing countries, developing markets, and bottom of the pyramid. And I was in Uganda last week, and I met a small venture that was a startup company that was providing accounting services and bookkeeping services, in part so that they could clearly create financial statements to go to a bank and be able to get credit and get a loan. So you may not have to have software, but you can hire an accountant or a service to be able to track these. If you can keep your transactions, if you have receipts for transactions, you can collect those, and then somebody can come in as a service and do those calculations for you and create those financial statements. And hopefully these companies not only use it to get money from the bank, but also use it to manage the business, which is what we're trying to advocate for in this course. So, what do we want to cover next? We covered software. There's one kind of specific topic that came up, and I maybe want to cover it again. It happened toward the end of my week, and it was talking about and the nature of IRR, or internal rate of return, and NPV, net present value, and how you decide which ones to use. By default, net present value is the clearest way to make decisions. That's always going to work for you because it will determine the value of a set of cash flows going forward. IRR sometimes is intuitive because it gives kind of a return. And maybe I want to draw this real quick here. If we talk about, because in supply chain we're doing more than just investing money. So if you remember the main graphic we had, let's see if I can zoom in here.
This will be a little bit over to this.
This way. Here we go. So if we have the firm here,
Is it backwards?
and we're investing in assets, then we get the cash flows. Hopefully you remember this diagram. Most of the time we're talking about this kind of situation where we have a firm investing in assets and then getting cash flows in return. And so in this case, we'll have a discount rate here, or a hurdle rate that we have to overcome in the sense that the cash flows have to give us a better return than the hurdle rate to get that investment. So that's when we're investing money that the firm has in assets. And that's what mostly the discounted cash flow analysis is used to evaluate, is investments inside of a company. An inventory reduction is something different because you're actually, in this case, reducing assets and then freeing up cash to go back to the firm. And so the tricky thing is, whereas in the investment, you want the IRR to be higher than the hurdle rate for an investment. For a reduction, you want the IRR to be less than the hurdle rate. Because what you're foregoing in cash flows is getting a lower return than what you can get in the marketplace for input into the firm. So this is where we're getting money into the firm from banks, et cetera. So if we can reduce assets by reducing inventory and put money into the firm, we better make sure that we're not having a return that's above the hurdle rate, because then we're foregoing cash flows that would be better than what we're getting back in terms of the firm. So it got a little complicated there, and it shows kind of the nature of how finance applied to supply chain to make supply chain decisions is a little different than just looking at pure corporate finance and when you're making investments. Because we oftentimes will do more than just invest in firms, like building warehouses or buying new trucks. We will often reduce assets, and we need to demonstrate that we're making a good choice of which assets to reduce. And we're creating cash for the firm that's not foregoing good returns that we could have received from those assets. So it's a little complicated, and we go over it with the Yellow River example, but I wanted to emphasize that that is not necessarily intuitive, and a lot of times people in corporate finance might not think of things that way, but the more that we can position our inventory reductions in this kind of way, we'll be able to communicate the value in a better way. So study the Milky Way using a pocket camera lens. All right. Well, sorry the camera didn't zoom in very well. But hopefully you can go back to that Yellow River example and kind of see again why that IRR is different. You use a different rule when you're reducing things rather than investing in things. So.
I hear that pocket cameras are improving their capabilities. I wanted to tackle a couple of questions that are somewhat short. The question was, do all the concepts hold true for cost-based accounting? It says and accrual accounting, I'm thinking, but versus accrual accounting. And the short answer is that the principles that exist for the accounting profession do indeed apply. The timing for some of the transactions will be different, though, and that's the distinction between cost and accrual-based accounting. Here's another question Sumit asked about: how do the tech companies decide the depreciation and make investment decisions in assets? Well, let me offer a couple of comments. I'd say that in terms of determining the depreciation or the depreciation rate, it really comes, this is one of those decisions that the firm has to make regarding the utility or the life of a particular asset. So there's some discretion that they can exercise, and there's advantages and disadvantages of each choosing a shorter or longer life. A shorter life will, of course, mean that there's a higher depreciation rate, which means that there will be a higher depreciation expense each year, which means they're writing off that there are more expenses in a particular year, and which means that they're going to be paying lower taxes in those years that are the early years that are being depreciated. And the same as the opposite is true for a longer life. But I think what the firm should be doing is taking into consideration a couple of things. First, the asset life really should be reflective of the utility of the asset in the context of the cost for actually tracking the utility of that. So if you have something is not a very high valued asset and you're going to spend a lot of money tracking that, well, then maybe you really shouldn't be depreciating it at all and just considering it as an expense, a period expense. The second consideration, besides the relative utility of the length of the utility of the asset, is to think about the broader financial strategy. If the firm is more interested in reducing their tax obligations in the near term, or possibly maintaining more assets on their balance sheet, there's a variety of different concerns and considerations that I think would come into play. And those are some of the things that I think that would matter.
And to build off of that, I think one of the important things, and we emphasize this in our class too, and I feel like we need to say it here, is that you talk about the strategy, and depending on what the strategy is. In supply chain, we're probably not going to be setting the strategy, especially regarding finance, but we need to be able to speak with them, right? We need to be able to be part of the conversation. So what we're teaching you here is some of the tools to be able to have that be in that conversation, but we're not going to set the strategy, but we should align with that. And we always advocate that you go make a good friend in finance. By being able to speak this language, you can make some good friends in finance and then work with them to make sure your initiatives are aligned with strategies, and that when you want to get some cash for your initiative, you can work with them to do that. So I have a question that's related to that that Lexi posted here, and was also posted online, about how do we set the discount rate or the hurdle rate, which I was just talking about. And this is another good example of, we don't do that in supply chain. That's not something we're going to be part of. It kind of defines the nature of this, is that we're not teaching corporate finance broadly, because there are parts of corporate finance that we in supply chain will not be part of. One of them is raising the funds and determining, based on how we can get money from investors and from banks, what the expected return will be, or what that hurdle rate will be. So that's something they will give us. Our role is to then take that hurdle rate and make sure that we're generating cash flows that exceed it, right? So we will not define it, and there's a whole myriad ways of approaching how do you raise capital, how do you determine the capital hurdle rate, but we don't cover that in our course, because in supply chain we're not involved in that. So it kind of defines the limit of where we get involved in finance, but we still want to be talking with them and talking with finance actively to make sure that our initiatives in supply chain and our designs are aligned with their goals. So.
On that, separately, the firm is, as Jared said, the supply chain folks don't make that decision, but in the decision that the firm makes in setting the hurdle rate, it is not just the cost of capital. What the firm usually decides is, it's generally speaking something higher than what the cost of money is to them, and because it reflects really an opportunity. So it's the decision that the firm makes. As Jared notes, the supply chain folks don't make that. It's generally higher than what the cost of money is to the firm. Sometimes it's an arbitrary 20%, or it could be something that varies each year depending on the number of opportunities and their actual cost of capital.
Got a few questions here on how do I calculate salvage value, how do I identify opportunity costs and sunk costs, if they're relevant or not, and engineers' time and requiring, in redesign, engineers' time, is it a sunk cost or opportunity cost? These are all great questions, and I think it gets at, and I hope you realize that the math of the discounted cash flows is not that complicated. If you have a good Excel spreadsheet and you're working with finance, who is probably going to be the ones that have to validate all the numbers anyway, the math isn't the complicated part. The difficulty is determining what's relevant to our supply chain initiatives. And I will say, I'll again advocate, the finance people have less information about what's relevant than you do in supply chain. You're a professional. You know how inventory is going to drive costs, how it's going to drive value. You're in a good position to determine what's relevant. And a one-week course online is not going to teach you all of that. We gave you the basic principles, again, with and without, and whether cash is flowing or not. Those are the two main principles to determine whether it's relevant. But how you determine that, it's not only you determining it too, you have to work with your colleagues to agree on whether it's relevant or not for your projections going forward. So that's the art, which is actually the more difficult part of doing this cash flow analysis. And I would say this course doesn't teach you all the different scenarios, but hopefully you have some principles that you can use going forward. And hopefully at some point some of you make it through all the courses and eventually can make it through the blended masters here and can be part of the discussion we have in our class here residentially, which gets a lot more into that. We talk about case studies, and we try to dissect and understand when a cash flow would be relevant or not, and that's more easily done in the context of a case or a discussion. So, but the other thing is, ask your colleagues. Go around and ask them, is this relevant or not? Those discussions you generate will be useful.
All right, we have 2 or 3 minutes left.
So I got one I want to get. So someone posted this question, and it's long, sort of a big wind-up here. It says, as we've learned, the role of accountants is very important for an enterprise. Actually, I like saying that because I cover the accounting stuff. So the role of the accountant is important.
Absolutely.
There you go. Since they manage all the financial information, the money of an enterprise. Given this, maybe they making a mistake could be easy. So are they, I think the writer goes on to say, what's the common practice to ensure that all the information is correct? And what about if they make a mistake? Well, let me address this by saying just a couple of things. There are typically some checks and balances inside the firm to make sure that the numbers are accurate. Of course, firms are obligated to engage an external accounting firm to conduct audits, and those accounting firms are checking the numbers. They're not checking the source of the numbers, and they're not checking some of the decisions that the firm makes as to whether the depreciation, the length of an asset life is proper. They're more looking at, did somebody follow the rules and the regulations in terms of recording the transactions? So I would be less concerned about someone making a mistake with the numbers, because you have an auditing firm, because there are checks and balances in the system. Because on a balance sheet, the assets are always equal to liabilities, as an example. I think the bigger question that exists, and that's for the firm, is relates to the interpretations. The accounting scandals that we read about are come from not someone making a mistake and transcribing a number wrong or incorrectly. It comes from someone interpreting something in a way that is far from the proper interpretation of law. And there's plenty of text on that. So again, I would be less concerned about the actual numbers being wrong, because I think there's lots of systems that will check that. And it's more on the interpretation. And that's where accountants and business managers can find their pathway leading to jail if they don't use proper method. Sorry.
Well, instead of going to jail, let's talk about how you can
stay out of jail.
Stay out of jail. And I do want to kind of close a little bit by saying, Jim and I did write an article. I think we posted an example, a link for it. It's learning the language of finance, or speaking the language of finance. And we'll post the link again. It's something we wrote in a Supply Chain Quarterly. I think you can get to it online. It kind of summarizes what we think are some of the key aspects that we as supply chain professionals can use in terms of using finance to help move our profession forward. Not only for you personally, but our profession in general, speaking this language better and having more impact on firms. So I'd encourage you to look at that, maybe even use it in your own company to help promote what you're trying to do. And I also want to kind of close here by, we don't get to talk with you. It's been kind of this distant thing, and I wish I could speak with each of you and interact, but we do appreciate that you value this content and you're learning a little bit about finance. I know there's a joke earlier about speaking 1.5x, so you're not used to us speaking normal speed. Well, some people think I speak 1.5x normally, so I don't know if you speed me up, I'm actually 2 or not. But and in part it's because, and the nature of this course also, we only did 2 weeks out of a longer semester course,
Yep.
And we probably compressed it a bit. I'm sorry if it was a bit intense. We put a lot of topics in there because we want to communicate a lot of these concepts to you. But hopefully you're finding them useful and valuable, and could get at least a flavor of the kinds of financial tools and language that you can use to help your professional career and move your career and your company go forward in terms of supply chain performance. So hopefully it was valuable to you, and we've enjoyed all the discussion, questions, and the chats, and hopefully we'll continue to see you again in these kinds of online sessions.
All right, so that was great. Let me just move this over. There we go. Okay, we're gonna wrap it up now. We went a little bit over. 3 things came out. Another question about auctions, first and second price strategies. Let's hold that off till next week, because next Friday at 10 a.m. Eastern Daylight Time. Professor Yossi Sheffi will talk about the different strategies for procurement, auctions, as well as supply chain contracts. So we'll cover that next time. Someone asked if they could come and visit the MicroMasters headquarters here at MIT. You're looking at it. So we're always here. And so if you're coming, please let us know. We'd always love to meet you guys in person. We're here all year. We don't go anywhere in the summer. And then someone asked, are there going to be future finance courses? So the MicroMasters itself is pretty well designed, right? But we will be creating additional courses. And so we've already talked about creating an additional supply chain finance course that'll be longer. And think of that as an elective. So we will be creating more of these. You got to give us some time though. So it probably won't be until 2017 at the earliest, to be honest. But if you come here through the blended program or come apply to the regular program, you can see them and take their course regularly. If not, you're going to have to wait till 2017 to see anything else we do online. With that, I want to bring this to a close, but we will keep the individual breakout session rooms open for the rest of the afternoon. I'll close them sometime like 5 o'clock today, but please feel free to pop in to carry on your private discussions. Anything else before we go? Frederick? Anyone?
Thank you.
Thanks, guys.
Thanks for taking the course.
Take care.
Thanks. Thank you.